All right, can you see the screen? Hello.
Yes, I can.
Okay, can we see the screen now? So welcome to tutorial class. Welcome to class today. I'm Pastor Ona Oluwashiro. That's my name. And then this is the second time we're having this tutorial. I want to believe that the last one was cleared enough, and then we will enjoy ourselves. So today we are moving into three things. Our focus today includes accounting equation, accounting measurement, and end of year adjustment. These are the three things we are going to look at today in our presentation. And then I believe that we are all going to enjoy the class by God's grace. Are we together? Okay. All right, so let's move on. So the first thing we are going to learn, and I want you to understand today, is what is called external transactions. They are activities conducted between the company and other entities. The entities might be other companies, other businesses, individuals, and corporate world. So that is what is meant to. That is the meaning of external transactions. So the effect of these transactions on the hello. Are we together?
Yes, sir.
Okay, the effect of these transactions on the financial position of a company are recorded in accounts. So the effect of the transactions that a company has with outsiders are being reflected or recorded in accounts. An account provides a record of all business activities related to a particular item. That's what we do in accounting. We make sure that we provide all records of business activities related to a particular item. So the balance of the account equals all activities that increase the account minus all activities that decrease the account. So there are some activities that will increase the account, like when you have sales now, say your sales will increase the account. And there are some activities too that will reduce your account, like when you have purchases. So the account we are talking about here is talking about the wealth of the business, and I mean the economy resources of the business. So some activities will occur that the economy resources of the business will have to increase, while some transactions will also occur that will reduce them. But that is what we are going to trash today. You see how assets are being increased and liabilities reduced, and so on and so forth like that. So I want you able to pay good attention as we continue, and you can ask questions anytime so that you can trash whatever and in any area that you don't have adequate understanding. So the first we are going to treat now is accounting equation. So what an accounting equation is. In accounting has an equation that we follow to balance our accounts. And the equation states that all assets is equal to liabilities plus shareholders equity. Let me quickly check if somebody is if I have people in the waiting room. Okay, we can move on from here. Sorry. Okay, so I was explaining accounting equation. I said accounting equation states that every asset of the business must equate with the liabilities and the equity of the business. The equity is talking about the owner's investments in the business, while the liabilities are talking about the indebtedness of the business, and the asset is talking about the properties of the business. So what I own as an asset in the business should be equal to what I'm owing people and what the business is owing me. What the business is owing me is my capital, because there is an entity concept of accounting that states that the owner of the business is different from the business. So the capital that is used to start the business is assumed to be borrowed from the owner in business, even though the business is yours. But the capital that you have used to commence the business is seen in accounting terms to be like a loan from the owner of the business. So the liabilities, what you are owing outsiders, and what the business is owing you, all together must equate with the asset in the business. Take for instance, if you have a motor car, if motor car is the only thing that you have in your business as asset, the cost of that motor car must equate with either the capital you have used to buy the motor car, or the small capital you use and the loan that you use to start the business. Let me break it down again. Let's assume when you wanted to buy the motor car in the business, the motor car is your asset. Now you bought it for 250k, for instance. I mean the motor car, which is the asset of the business. And out of that 250k, you contributed 100,000 and you borrowed 150k. So you use the 250k to buy the car. So the 250k you use in purchasing the car must equate with that money you are owing the people, which is the 150k, and the 100,000 that you two brought into the business. So at any point in time in accounting, asset must equate with liabilities and equity. So I have some notes here that we should go through. Please, can we switch off our what's it called, the mic, so that we can enjoy ourselves, please. So if the total asset increase, if the asset here increases, either the liability or the equity must increase, because at every particular point in time the equation must balance. This side of assets, this side of liability and stakeholders fund must not be greater than the resources, which is the asset of the business. The asset of the business too must not be greater than the liabilities and the shareholders fund in the business. So whatever happens to one side must happen to the other side, because at any point in time the equation must balance. So if total assets decreases, then liabilities or stakeholders equity too must decrease by the same amount of money. So if we reduce this place with 200 naira, we must reduce either this liability or the stakeholders equity too with 200 naira, so that the accounting equation will balance. This is referred to as double entry system. In accounting, accounting does not fly with one wing, and we don't work with one leg. We work with two legs. So we have the debit side and the credit side, and every point in time the two must balance. So this equation is more or less like debiting and crediting transactions. So at any point in time, no side shall exceed the other. So this side must be equal. I hope we are following. Hello? Hello? Are we together?
We're actually together, but there's a noise in the background that is obstructing the audio.
The noise is not coming from my end. It should be from somebody's end there. If everybody can off their mic.
Off the audio. I think that's what's coming from them.
Sir? Can I get you, sir?
I said the person called Ike was the one who's was not muted then.
Okay.
It was really disturbing.
Thank you, sir. So, but did you get the explanation, or I explain again? Because I want us to get this preliminary stage.
Explain again. You might just need to go over it again.
Because if you don't get it from now, we'll find it somehow. I won't say difficult, but somehow when we move on. I said in accounting, there is an equation that we follow in accounting. I said accounting does not work with one leg. We work with two legs, and we fly with two wings. At every point in time, our equation must balance. The equation has three elements, which is assets, liabilities, and stakeholders equity. That is the capital of the business. or funds of the business. Now, the capital of the business and the liabilities are together, one side. If you remember last week when I did a balance sheet for us, which is the statement, the financial statement, the statement that shows the financial position of the business, I showed you where the assets were and where the liabilities are. Is of two sides. So the assets are on one side, the liabilities and the stakeholders fund are on the other side. The two of them must balance without you removing anything from anywhere. Other balances can be you deduct this side from this side, you say balance carry down. But in balance sheet, we don't have balance carry down, we don't have balance brought forward. What we have is that the account must balance at the end of the day. Now, and by doing that, we are following the equation, accounting equation, which says that every asset must equate with the liabilities and the stakeholders fund. I now use I made an example. I said, let's for instance now, let's assume you want to start a business. Let's assume you want to start a transport business, and in that transport business, you need to start with one vehicle, for instance, and that vehicle is 2.5 million. Fine. The cost of the vehicle is 2.5 million. How do you generate that cost? If you put down the whole 2.5 million, that means that you only have equity. You don't have liabilities. And when you buy that vehicle, the vehicle becomes your asset. So the cost of the vehicle must equate with the cost of your equity at any point in time. If anything happens to that vehicle and the cost reduces, your equity too is reducing. Now, if you combine resources together to buy the car, getting loan from a bank like 1.5 million, and then you added 1 million to it to make it 2.5 million to buy the vehicle that you are going to use for transport business. In that transport business, your liability is 1.5 and your shareholders fund, that is the owner's fund, is 1 million. The two together is 2.5 million, equating the cost of the asset, which is the vehicle. So at any point in time, this equation must balance. If the equation does not balance, then there is a problem somewhere, and then we need to look at the problem. That's why some people will sleep overnight in their offices looking for balances. So if total asset increases, if you buy another vehicle again, maybe you bought the second vehicle for 3 million, your asset base will increase to 5.5 million. 2.5 million plus 3 million vehicle that you bought. Your stakeholders fund or your liability, depending on the combination you use to purchase that vehicle, will definitely increase. So the equation must balance at every point in time. Likewise, if the total asset decreases too, then the liabilities or the stakeholders equity too must decrease. So that the equation will balance. And I said it earlier on that this is also what we refer to a double entry system in accounting. As you are debiting one side, you must credit the other side so that the two sides will balance with the same amount of money with different transactions. Because we started from external transactions. External transactions are transactions that an entity has with other entities. So, and those are the things that we bring into accounting to make sure that at any point in time there are balances. So if I give you money now, or I borrow you money now, you are my creditor, I'm your debtor. So in your own account, you put yourself there as a creditor. In your own account, rather, you put me as debtors, and then you are the creditor. So the debtor will have the debit side, the creditor will have the credit side. The account will balance. At every point in time, account must balance. So that is what we have just explained. And I think it's clear enough. I should just move on. Do I have your yes?
Yes, it is.
Okay. All right, so look at it, this place too.
Yes, sir.
I want to also explain more on the equity, the shareholders' equity. The shareholders' equity here, when we say equity of the owner of the business, it is both the real capital contributed and the retained earnings. If you also remember last week, we discussed about retained earnings. Retained earnings are profit that a company did not share, that is being plowed back into the business, is retained for business growth. So if you make a profit of 1.5 million, for instance, and you share like 1 million naira to the shareholders, the 500,000 you did not share is retained earning. Is also still part of the capital of the owners of the business, though as retained earnings. And this retained earnings, which is profit, is coming from the revenues you have gained, or the revenues you have collected, which is the sales you have made, minus all your expenses, plus maybe dividend that you received, to make your retained earnings. So when we talk about shareholders' equity, you are talking about the real capital that they brought into the business and other profits that have been plowed back or retained in the business, minus drawings. Because sometimes if you are in the one-man business, if you are selling rice, you may tell your children sometimes, this rice, you are going to take 1 derica of rice, cook it without paying to the business. Those are drawings, and it is indirectly reducing the money you have into the business. That's why some traders, husbands will fund their businesses, but not knowing that as they are also taking from it, the capital is good. At the end of the day, when everything is gone, the husband start blaming the wife. You shop the business, you shop the this, you shop the that. Not knowing that when you were telling the wife, actually we have rice now, take the 2 dericas, you're supposed to pay back those 2 dericas because you are an entity different from the business. So the business is separated from you, even though you are the owner of the business. So the shareholders' equity we are talking about here has a common stock, which is the real capital and the retained earnings. And we cannot get profit except their sales and their expenses are matched to the sales to get profit. That we will not share some and retain some. I want to believe you are getting it. And the liabilities here are your indebtedness to the business, those people that you are owing, whether long-term loans, short-term loans, overdrafts, accruals, and so on and so forth. But when we add them together, they must equate with the assets of the business. That one is very, very sure, and is non-negotiable. If not, your account does not balance. So let's move to the next slide. Now look at this place now. This place also explain more about the elements of the accounting equation. We have the assets here, just for you to remember. Last week we discussed fully on these things. Our assets include land or land and building. We have furnitures and fittings, equipment, supplies or inventories. Account receivable. This is receivable. Typographic error, sorry. Account receivable and prepaid rent and cash. Or cash is either it is cash at hand or cash in the bank. All these things and lots that we did not mention are assets. Then your liabilities are your account payables, what you're supposed to pay that you have not paid. Deferred revenue, maybe somebody pay money to you in advance and you collected it. It's a liability to you and it's an asset to that person. So it will show in that person's balance sheet as asset, but it will show in your own balance sheet as liability. Then notes payable, we treated some of these things last week when we met. Then the shareholders equity, we have the common stock, which is the capital. We have the retained earnings, which can be generated from which can be classified as maybe the dividend the business received, the revenue, sales revenue. And I say here that these expenses, I put them in bracket because they will be subtracted from the revenue, sales revenue, to get your profit. It is from that profit that dividend will be declared and shared, and the remaining dividend will now be retained in the business. That is just the explanation of the elements and of the accounting equation. And please don't forget that at any point in time, this equation must balance. The asset must equate the liabilities of the business. Okay, so what is the effect of these transactions on accounting equation? You see, account records all transactions related to a particular item over a period of time. We discussed that last time. So asset accounts, example, cash, supplies, and just what I've just discussed now. So we don't need to bother to further waste time on this slide. So let's move on to the next one. Look at this example, for instance. He said sell shares of common stock for $1 million to obtain the funds necessary to start a business. Now, this company wants to organize a business and then declare to the public that they should come and buy shares.
Sir, I can't see the slide.
You can't see it? You can't see the slide? Is there anybody here there too that cannot see the slide?
I don't know if it has appeared now. Just
I can see the slide.
So I can check your phone, sir. Others can see the slide. So let me continue. So you make a public offer that the public should buy shares in your company to generate this money that you are going to use to start this business. Now, if this money comes into your account, bam, is referred to as cash, and cash is an asset. That's why you see $1 million here. So your cash has increased by 1 million naira, and this cash is representing the amount of money people contributed into your business as capital. So it is a common share. So when you look at it, there's 1 million here and there's 1 million here. The accounting equation must be equal. So the asset increased here by $1 million, and the liabilities too increased, or the equity, shareholders' equity also increased by 1 million. So if you can understand this posting, it is not going to be a difficult thing at all. I will get to a level whereby you see how they occur in only one aspect, but the accounting equation will still balance. Okay, let's move on. Look at this example too. You borrow cash from the bank. Now, when you borrow money from the bank, definitely borrow $500 from the local bank and sign a note promising to repay the full amount of money or debt in 3 years. This is a form of loan. So this person took loan from the bank. I believe he took loan from the bank. Your asset will increase. So your cash will increase by 500,000. And your liability also will increase, because that one is not your money. It is money that belongs to somebody. So your liability will increase by 500,000. At the end of the day, your asset now is 1.5 million and your liabilities too are 1.5 million. Accounting equation must balance at every point in time. Can I fire?
Fire, continue.
Okay.
Yes.
Thank you. So purchase equipment. When you purchase an equipment, it depends on how you purchase it, whether by cash or by bank or on credit, either of the way. So you purchase equipment necessary to customize its robot for 240,000. When you purchase an equipment, your asset has increased by 240,000. Then how do you purchase it? You paid cash to purchase that equipment. It's not by liability. You are not bringing in more money. So your cash will reduce by 240 and your equipment will increase by 240. Account equation still balance. So this one now does not affect the other side. It only affected the aspect of the cash, of the asset. You paid 240,000 naira for an equipment. Definitely your fund has reduced by 240. But that fund that reduced by 240 is representing the equipment that you bought. You are seeing the equipment, that's your fund, in form of assets, fixed asset now, long-term asset equipment. And it is the combination of the long-term asset and the current asset that makes up the assets of the organization. So the asset is still 1.5 million, though we have now included equipment, which is a fixed asset, into it, but our accounting equation still balances. So when the question is silent about the source of payment, take it as cash. When you are giving questions and they did not mention whether the money is being paid by check, it's being paid by check, then you take it as a cash transaction. When it is being paid in check or by check, it will be mentioned. But when they are silent, you take it as a cash stuff. And presently, they even have cash in the business. They don't have money in the bank, they have cash. So the person just they are not practicing cashless policy yet in this question. So that is how to treat this kind of people. So sometimes the adjustment will come on only one side, but the accounting equation will still definitely balance. Look at this one. Purchase supplies on account. Purchase supplies on account 14,000 naira. Note that purchase on account means on credit. So anytime you hear purchase supplies on account, it means that you purchase those things on credit. So how do we treat this kind of a thing? Can anyone give us answer? Anybody? I don't want this class to look as if I'm the only one talking. So you purchase supplies. Your supplies here means.
Repeat the question.
Sir? The question is on the screen.
So repeat the question.
The question is on the screen. Can you see the screen?
Mine fluctuates. It came out, it went
Okay.
out.
Purchase supplies on account $14,000. How do we treat that? And I put a note there that when you hear purchase on account or sold on account, it means it is in credit. So you purchase inventories on account 14,000. So how do we treat that?
You add it under the liability.
Okay.
And then under asset too.
Which assets are we creating there?
I don't know.
You are correct by saying that it will go to asset and liability. Correct. But which assets are we talking about here and which liability? Because there are liabilities. We have long-term liability, we have short-term liability. So which one of them? Which asset are we also saying? Is it cash? Is it fixed asset? Is it current asset? If it is current asset, which current asset?
It should be short-term liability.
Yes, short-term liability. Which of the short-term liabilities? We have many of them.
Oh Lord.
The Lord you called will help. Anyone who call upon him, he will answer.
Oh Lord.
Yeah, that's another clue. Madam has said that it's a short-term asset, so that one too is very, very correct. But which one of you can't just say short-term asset in accounting? You have to be specific.
Okay, do you mind throwing more lights on that?
Okay, so we purchase supplies. We purchase supplies. So, and I take supplies to be, sorry, I've left that place. I took supply to be inventories. So that is the asset that was purchased. So under your asset, you have inventory of 14,000. And then since it was purchased on account, under the liability, you have 14,000. Accounting equation balances. Let's move to the next one. Purchase inventory with cash. Oh yeah. You purchase inventory with cash.
Are we done with the previous one?
Yeah, that's just it now. That's how to post it. I've just explained.
Okay, I'm sorry. So which
I should explain.
Which short term there were the languages you used that at least just bring it up again. Let's know.
Okay. Purchase supplies. In accounting, what you really purchase is what we use to represent that item that is being purchased. I said that I took these supplies as inventories, like stocks. Like let's assume you purchase motor vehicle. So, but motor vehicle is a fixed asset, but this one is under current short-term assets, as somebody rightly said, which was correct. And what was purchased were supplies. So supplies will be the asset that will be created under the asset for 14,000. And the liability side, we have 14,000 there for the liability side, which will be creditors.
Okay.
Under the liability, it will be creditors. That will be 14,000 under the liabilities. Because liabilities too, we have accruals, we have loan, we have overdraft, and so on and so forth like that. So, but this particular one, since it was on account, it will be creditors for 14,000 under liabilities, and supplies or inventories 14,000 under the current assets. Under assets. So the accounting equation balances. So I can move on now. So let's look at this one. You purchase inventory with cash, 750,000 in cash. Anybody? Are we still there?
That is pretty plain.
Eh?
Yeah, it's pretty plain. Your asset, I think, is straight up now. Liabilities and assets.
How is liability coming up here, sir?
Is debited from your asset.
How is liability coming up here, sir?
Okay, based on the fact that we paid.
Based on?
Okay. Okay, because it's cash, it shouldn't come up. But when does this now place? Something else, man.
This is very easy. It's very, very easy. Very, very easy. Just calm down and look at it. Inventory and cash are both assets in short-term funds. Cash and inventory. Sorry. The cash and the inventory are both short-term. They're both short-term assets, and the two of them are now affected in this. So we are not even going to the liability and equity fund at all. What we are going to do is to go and remove 750 from our cash and add 750 to the inventory. The account will stay balanced. Because we paid by cash, definitely our cash has reduced by 750. And our inventory, our goods that we bought into the shop or into the business has increased by 750. So inventory will increase while cash will reduce. All under assets, account will stay balanced. Are we there?
Okay.
Do you get it? Please, if you don't get it, you
so
talk.
The account is being built. It develops like more of a tree with branches, like a family tree.
Exactly. But the branches are still under the vine.
The three major things: asset, liabilities, and stockholders' equity.
I don't understand what you say, sir, but I don't understand. But I hope you understood what I said.
Yeah, I think so.
Can we move on?
Yes, you can.
It's only you that is talking. Where are others? Are they still there?
Move on, sir.
Okay, thank you, sir. All right, so look at this transaction 7. Sell inventory for cash and on account. So sell 5 units at a price of $70,000 per unit for a total of this. So here, this question does not specify the required posting. If A are selling price, receivables will increase. You know, it's on account. So since it is on account and you sold goods on credit, you will definitely have a revenue and also have debtors. When you sold goods on credit, you have revenue and you also have debtors. So the debtors are the receivables, which will be created under assets. And the inventory sold, that's the revenue, which will be created under equity, shareholders equity, that is revenue. under retained earnings. So this kind, when I went through this thing, there was a way they did this thing that the information was not complete. So that prompted me to explain this. If you are to post this transaction at selling price, you will post 350 to receivables under assets and 350 as revenue or retained earning under shareholders equity. But if you are to post at cost plus profit element, then you have to think, how much was this thing purchased? The cost of purchase will be multiplied by that 5, removed from this, because when you sold goods, your inventory too has reduced. Your inventory has reduced when you sold goods.
That's true.
Yeah, so it has reduced. So, but if you are posting it at selling price, it's very, very easy. You just post retained earnings 350,000 under the capital and equity, owner's equity, and then you post 350 to receivables. But if you are to find out the profit element, then you will post the profit, the cost under the, what's it called, under the stock, and the balance under the receivables. Hello? Are we together? So the cost reduces the inventory and the earnings. So the profit element will increase the cash and the earnings. So that is just the way it will be treated if it is at cost plus profit element. But normally, because I saw one question in the future, we are still going to treat it when we get there. That has to do with you posting using selling price and also post using cost price. So they are just doing that so that you can remove the profit element and post correctly and post the cost element correctly. Because when you sold goods, there is a cost there and there is also profit element in the sales. You have added your profit to that cost before making your selling price known to the people. So this is how to treat this kind of a question. Okay. Then receive cash in advance from customers. When you receive cash in advance from customers, what happens? You receive cash in advance from customers. It's already here. Your cash increases.
Yeah.
Your cash increases and you now have a deferred revenue. It is a kind of revenue that you have not rendered the service. So you can't recognize it yet as your profit or retained earning. It's a liability on you because somebody paid you in advance. So as you receive the asset, which is 100,000, you have a liability of 100,000, and that liability is called deferred revenue because it's a revenue that you have not worked for. It has not accrued, but you have collected the cash in advance. So every element in accounting has their name and their category where they are going to. But at any point in time, the accounting equation balances. So we should know today that there are assets and there are many. Look at this place now. We have cash, account receivable, we have supplies, which is inventory, we have prepaid rent, we have inventory, we have equipment. So all these ones are assets. They are still all under assets. Look at liabilities. We have account payable, note payable, deferred revenue. We have common stock, retained earnings under equities and shares equity. But when they added everything together, it must equate with what we have together to where we add all our assets. So that is just so. What you need to know is that if I'm posting this into under assets, for what? Which name am I giving to it under the asset? If I'm posting it under liabilities, which name am I giving to it under the liability? If it's going to be under stakeholders equity, which name? Is it a common stock, retain any dividend or anything, or what? So you have to note that when you are posting to those sides of accounting equation. All right. So from there we move to the next focus, which is the double entry system. Hello, what's happening? Oh? Hello.
Hello, we are with you, sir.
That noise, okay, it's not affecting people, right? Okay, let's move on.
Not really. Not really.
Okay.
It's like
It's affecting now. Everybody has to do something.
Okay, so the double entry system, I've said it before that
you call the person about.
Professor, the thing is that here in Nigeria, we are usually having interfacing. Hello.
Hello. Hello.
You just have to mute your device.
Please mute. If you are not speaking, you mute your what's it called? Your audio mic, so that you just hear us. And if you want to speak, you put it on, you speak, then we hear you. Okay, so we are on double entry system. And I said it earlier on that what we have just done in an accounting equation is also what we do in double entry system. And that one is more deeper. In fact, if I was the one to prepare this lesson, I would have brought double entry system first and now bring accounting equation later. So that with the idea of double entry system, you'll have understood what we are going to be doing under accounting equation. Because there too, you need the knowledge of double entry system to know where to post and what it is for. So in the double entry system, we believe in accounting that every debit entry transaction must have a corresponding credit entry. If I give you money now, it's going out, my asset is reducing, your own asset is increasing. So the person receiving it will be debited, while the person giving it out will be credited. With the same amount of money, account will still balance at the end of the day. So when we are talking about double entry system, we are talking about recognizing who is to be debited and who is to be credited in this accounting stuff. I have some explanation for that. Let me go to the next slide. So format for recording business transactions or journal entries. Now, we have something we call journal entry to record. This is a journal entry. We have two ways of presenting transactions using double entry system. We have the T format and we have the vertical format. The vertical format is what we refer to as the journal entry, and it has principles. This journal entry has principles that guide it. Number one principle is that the first item starts from the margin. The first item starts from the margin line here. I hope you can see my pointer. And the second transaction, which is the credit side transaction, has an indent before you start to write it. In fact, it was in this manual, it was noted that some students used to make this kind of mistake when they are using journal to record accounting transactions. So if you know the account you are going to debit, you write that one first, then you move to the account that you are going to credit and write it on the credit side. So this journal has two sides. We have the debit side and the credit side. So the debit side is recording the receipt. I have it in one slide there. It's recording the receipts in the business, while the credit side is recording the outflows in the business. Okay, I said that all assets, expenses, and receipts are okay. I will explain this. Let me just move. See this on December 1, Eagle Robotics sells shares of common clinical to investors for cash of this. We sold shares to investors of cash of this. So that shares we sold, we collected it cash, and it means that we have a common stock, which is capital in that business, and the capital will be credited while the cash that we have received will be debited. So we debit the cash account, which is 100,000 in cash. It means that our cash has increased with $100,000, and then this cash now that increased is an asset. What area of liability we merge it to make it balance? Is a common stock. So common stock will be credited to balance up the debit side of the account. So if we add these two together now, if we add this one here and write the answer here, if we write and write the answer here and also add our credit side together, it must at the end of the day balance using the journal. Excuse me. So the cash here is increased. So whenever there is increase in assets, it will be debited, and whenever there is increase in liabilities, it will be credited, though the other side of it will be debited. So note, all assets, please note this, all assets, expenses and receipts are debit entries. In most cases, let me use that word. In most cases, all our assets, expenses and receipts means inflows, when you receive money in, all of them are debit entries. So when you see question, think, am I receiving money or I'm sending money? If you are receiving money or money is coming in, it's going to be on the debit side. But all income, liabilities, equities and payments are credit entries in that account. So we are maintaining one account here, and that account we have both debit side and credit side. When that particular account is receiving, you go to the debit side of that account. When that particular account is giving out, it will be in the credit side. Take for instance, you have cash in your hand. When you buy something, definitely when you buy something, that thing that you have bought, the person selling it to you have received money. That's an income to that person. So the person's account will be debited. While you that pay that money, your account will be credited. And if somebody buys goods from you and paid you money, you have received the money. So your own account that you have received in will be debited, while that person that pay you will be credited. So that is the way we work in accounting. And that is the way, with that, the accounting equation is still balanced. Okay, so we are moving to the last part of this tutorial tonight before I receive questions, which is accounting measurement and value recognition principles. In accounting, there are two bases that we follow in accounting, though one is fading out gradually is fading out, and the other one is taking over. We have accrual basis and cash basis. In accounting, we have accrual basis and cash basis. What is the meaning of these two bases in accounting? Accrual basis. Under accrual based accounting, accrual basis accounting principle, economic events that affect assets, liabilities, revenues and expenses are recorded as they occur. In accrual basis, when something occurs, that is when we recognize and record it, not necessarily when it is being backed up by payment. But in our cash basis accounting, it is when we record transaction only at the time cash is received or paid. Cash basis says that every transaction that has to do with inflows and outflows of physical cash, that is what I will write down. But accrual basis said no, there are some transactions that will not involve immediate payment of cash. If you leave them out of your business have not captured the real information that is needed to capture, and it will not show true and fair view. Therefore, you need to capture them into the business. That will amount to you recognizing liabilities, recognizing receivables, recognizing creditors, recognizing accruals, and so on, and prepaids, and so on and so forth. Those things have not really involved cash payment, but they have occurred in the business. You need to capture them. That's accrual basis. So accrual basis is saying that it is not only when money is received that a transaction should be treated. A transaction is treated when service is rendered and when services is enjoyed. Like now, if I'm preparing my own account, even though I've not received cash for this tutorial, I have a projection already what I'm expecting, and I can put that into my account as an income, and put you people as my receivables in my balance sheet, and my account will still balance. So the issue under accruals is saying that it is not when the service is rendered and that service is enjoyed by the same person who received the service, transaction has taken effect, you can post. But cash basis is that no, but the money has not been paid. Until the money is paid, before me I will write it down. So cash basis accounting is somehow shallow compared to Accra basis accounting. Look at these two informations here. We have the cash basis compared with the Accra basis. Now look at this. Sell 5 robots for cash 70,000. So when you sold goods for cash 70,000, you recognize at the end of the day, Accra basis and cash basis will still recognize the money, but the timing at which they recognize the money are different. The cash will wait till the money is being paid. Accra will say no, let me record it down. So look at this cash now. Under the Accra basis, they wrote it down under revenue recorded, and cash too under revenue recorded, because it has actually been paid. But on account means on credit. Cash will not write it down, because cash will say that I have not received this money, it's on credit. But Accra basis will say yes, since it's on credit, you still recognize sales, and then you recognize your debtors. Then you move on. It shows that you have debtors that are giving you money in the account, other than you just leaving it outrightly without tracing. It will give you a problem at the end of the day. You will know what you have sold, how your goods have been, how your inventories have reduced in the store, and so on and so forth. So when goods are sold on credit, cash will not record it down, because cash basis, the cash book says that everything that has to do with physical cash, inflows and outflows that I'm dealing with. But Accra basis says no, me, I will recognize them as either assets in form of receivables and liabilities in form of creditors as I move on with my account. So that is the difference between the two accounting basis. And I think the one that follow GAPS means generally accepted accounting principle, is the Accra basis. And that's why globally, in fact in government setup now, they have also been trying to bring in Accra basis, because government before, they use cash basis in recording their transactions. That's why they don't have something that's called depreciation in their accounts. But now things are changing gradually. When they buy a vehicle of 10 million, they just put it in the cash book, and that goes that they bought it 10 million naira. So that's why government don't prepare income statement. They prepare they prepare income and expenditure account, not in terms of comprehensive income statement where all accruals will be recognized. So, but now things are changing with International Public Sector Statement of Accounting Standards, IPSAS. Things are changing because globally now people are recognizing Accra basis compared to cash basis, and that's why Accra basis follow the gap, but cash basis does not follow the gap. So timing differences under both Accra basis and cash basis accounting, all revenues and expenses are evenly recorded for the same amount. Yes, the amount does not differ, but the difference between the Accra basis and the cash basis is the timing. Why one is waiting till the money is being paid before recording it, one has already put it into recording, and then the account moves on. So generally accepted accounting principles, cash basis accounting is not part of generally accepted accounting principles. So there are some organizations that if you prepare the accounts and you follow cash basis, they will reject it because it's not showing the true picture of the business. But Accra basis shows everything that happened in the business. Hello, are we still together?
Yes.
Okay. All right, so look at this adjustment at the end of the year period. Now in Accra basis, Accra basis develops some other adjustment in accounting at the end of the period that cash basis will not look into. Take for instance, on December 1st, you purchase 1 year of, somebody paid 1 year of rent in advance, and per month is 15,000 naira per month. For 1 year times 12, that will amount to $180,000. Okay, we are dealing with dollars. $180,000 for a whole year. Akura is saying that you can't recognize all these $180,000 in this December period. If your accounting period, or this question is treating this transaction as if the accounting period of this business ends in December. So you will look at when is your accounting period ending. So this one is treated as if the accounting period ends in December. So if somebody has an accounting period from January to December and pay $180,000 for rent, for 1 year rent, but in the business you have only recognized you have only used the rent for 1 month, from December 1st to December 31st. So there is no point writing $180,000 into your account for that year. You only put the $15,000 per month in that account for that year, and the remaining money will be prepayment, which is an advance payment, an asset they are still going to enjoy in the years to come. So that one will be recognized as assets in your business. Whereby but your account has already been reduced by $180,000 cash because you've paid. So your assets have been reduced by $180,000 cash because you have paid, but your what's it called? Your repayment, the repayment is $15,000 for that accounting period. $15,000 minus this will give us like $165,000. So that $165,000 represents your prepayment for the year, which will be in your current assets. Look at this one. You purchase an equipment for cash, $240,000. In your cash book, you just move $240,000 and go. But the accounting principle says that no, this asset was actually purchased in December 1st. It will be an overstatement of expenses to reduce profit if we put all these $240,000 into this account as at December 2020 whatever year. So you only recognize 1 month, and that 1 month depends on the depreciation method you have adopted as a policy in your business. If it is a straight line method or reducing balancing method or some of the year-digit methods and so on and so forth. So you compute a depreciation on this equipment and recognize it in your business for that December and shift the remaining money as net book value in the balance sheet, which is your value that you still have to enjoy in the years to come. Because it's not possible that when you purchase an equipment in a year, you use all the money in a year. The equipment can still sell for 2 years, 3 years. So why are you recognizing the whole money now in 1 year? It will affect your profit, to affect the account. So you need to compute a kind of depreciation on it. Look at this one. By December 31st, $3,000 in salaries have been earned by employees for the final 3 days of the month. So they earn $3,000 salary have been earned by 31st of December by employees for the final 3 days of the. So they've already worked for the final 3 days of the year. So you calculate that final 3 days of the year, remove from this, that's what you will recognize as your salary for that year. The remaining money is an advance payment to them, which is be an asset. Income tax costs $15,000 have been incurred but have not been paid. So we assume that by this 31st day of December and your income has been specified, your tax too has also been specified for the year. So for that year, you are paying tax of $15,000, but you have not paid it. In accounting, you recognize it as if it has been paid in your income statement. That will help you to show the true picture for that, true picture of your profit for that year. But that money has not been actually paid you, so it will be a liability to the business. When you now pay, it will net it off, because when it is liability today, under liability aspect we have $15,000. When you net it off with cash in the nearest future, it will go off from the account. So the account will do what? We balance. Those are the treatments that we need to sit down again and again and again and again and learn. And I saw some questions I copied here to also explain the class. If a company pays an employee $100 per day for a 5-day work, for a 5-day week that runs from Monday to Friday. In this place, in this company, they pay 100 naira per day, and a week is from Monday to Friday for a week. That will be 500 naira, $500 per week. And December 31st is a Tuesday. December 31st is a Tuesday. What is the amount of the salary adjustment, assuming the Friday is payday? If Friday is payday and 31st December is Tuesday, then you won't give them all the 500 naira now. You can compute Monday and Tuesday, because they actually work for 2 days in that week, and you give them their $200 instead of $500 that you're supposed to pay them. That is an adjustment, and that is the way it works in accounting. Because if you pay them the whole 500 naira, you have lost money. You have paid for what they don't work for. So you have a kind of advance payment, and they are your debtors too, because they are owing you that additional money being paid to them. A company borrowed $20,000 until November 1st at the rate of 6% annually. How much interest expense will be accrued at the year end? These are good questions, and a very good question that one is to. November 1st, is November 1st, so it means that loan has just been used in the month of November and December, 2 months, but the interest is 6% annually. So the interest is for 12 months. So when you compose 6% of 20,000, that will be like $1,200 divided by 12. That's like $1,000 times 2 months that you have just used. You like get that calculation very well. 6% of 20,000 is for the whole month, for the whole year rather. Then you have just done the business for 2 months, because the accounting period stops in December. So November and December. So those 2 months will now be 2 over 12 times 6% of 20,000. Then your answer should be 1,200. No. Calculate it. I can't calculate this one now from my brain. No. Okay, 6%, that's 0 comes 0. That's 6 times 200 will give us 1,200 divided by 12. 1,200 divided by 12, that will be like 120. No, that's 100 naira. Yes, that's 100 naira. So that's the interest payable per month is 100 naira. The 100 naira times 2 months, that will be $200. So B is the answer in this place. Okay. This is the end of the class for today. I want to believe that you are still with me, and if you are not there, I know that you will catch up with maybe the video that I'm making, and then we move on. Any question before we close for today?